Welcome to Klingenstein Fields Advisors Investment Outlook. I'm Susan Curry, Chief Operating Officer, and I'm here with Greg Galinsky, our Head of Analytics and Risk Management at the firm. Greg, after a tumultuous start to the second quarter, things seem to have settled down a little bit. Can you tell us what's been going on?
Sure. Well, the beginning of April was quite volatile in response to tariff announcements, but expectations shifted to a more moderate trade policy. And as that's happened, the markets have recovered, and the S&P is up 7.2% through July 9th, while international and emerging markets have risen dramatically.
What changed with the tariffs?
While the original scope of the tariffs appeared severe and the beginning of a potential trade war, there's strong signs the administration's stance was part of a broader negotiation strategy, and this shift in outlook helped drive positive investor sentiment and a significant rebound in the capital markets.
What about the new tax and spending bill? What is the impact of that likely to be?
The bill is very wide sweeping, so the full economic impact is difficult to quantify. The nearer term effects are clearer, with most economists forecasting modest economic stimulus over the next 1 to 2 years, which has helped lift market sentiment.
Should we be concerned that the markets are too dependent on a smaller subset of stocks for returns?
We've talked quite a bit over the past year or two about the impact of the Magnificent Seven on the markets, which are up approximately 39% since their April 8th lows. While it is true that a small number of stocks do represent a large part of the S&P 500's market cap, it's also important to note they account for a larger part of the S&P 500's net income versus a couple decades ago. In addition, the composition of the S&P 500 has changed significantly during that same time, with the current top 10 stocks possessing deep ties to AI, cloud computing, and advanced technology. While there's risk in the fact that many companies' growth prospects are tied to technology-related themes, the current environment is different from the tech bubble of 2000, when valuations far exceeded earnings growth, which is not the case today.
Can you talk a little bit about the importance of staying invested for the long term?
One of the greatest athletes of all time, Roger Federer, once noted that although he won around 80% of his matches, he only won about 54% of the individual points played, demonstrating that it's important to stay in the game, a principle that can be applied to investing as well. Missing just the 20 best days in the market since the late 1980s resulted in significantly lower returns.
What are you keeping your eye on, and what is our message to clients?
With the recent rally, there is the risk of a pullback, although we do not see the structural imbalances that typically precede a major market correction. We continue to keep a close eye on inflation and the Fed's interest rate policy, watching carefully to see if tariffs and fiscal stimulus exert inflationary pressure. We are also monitoring the impact of the new tax and spending law. Again, we stress the importance of remaining invested for the long term.
Thanks, Greg, for that helpful insight. To access the full text of our investment outlook, please click on the link below. And as always, please reach out to us with any questions or concerns that you may have.